Welcome to the Dealreporter podcast. Hello, I'm Juliana Needham. We've got lots to get through today: the UK IPO revival, the fertiliser merger and tax inversions. I'm joined by John West, Dealreporter's ECM editor, by Gustav Sandstrom, our Nordics reporter, and by Alex Tarrant. So John, starting with you, the UK IPO pipeline was on hold until the Scottish independence referendum on the 18th of September was done and dusted. With that behind us, who's come forward?
Most notably, Aldermore Bank. Financials were hardest hit by the uncertainty surrounding the Scottish referendum, and it filed its intention to float pretty much directly afterwards on the 22nd of September. They're targeting primary capital raising issuance of £75 million, but our sources are telling us that a free float is likely to come in at 35%, which would imply full issuance of £300 million or thereabouts, a nice payday for their private equity backer, Anacap. Elsewhere, the luxury shoe manufacturer Jimmy Choo has filed its intention to float also in the same time, 23rd of September, and that valuation could come in roughly at £700 million. We've also had intention to float statements from Miller Homes and Avenue Capital Credit Opportunities.
But it's perhaps not the post-referendum glut of IPOs that we were expecting. Why is that?
It isn't. I mean, the UK. It's worth remembering the UK was far and away the most active IPO market at the beginning of the year. But for every IPO that got away very cleanly and traded well, there have been a pets at home or an appliances online that didn't do so well. So investors are a bit more cautious. And I think that's led also to companies running their dual tracks a little longer. So we're seeing United Biscuits that perhaps people might have expected the ITF to come, the intention to float, but they're still welcoming bids from the likes of Burton's and Kellogg's, according to reports. Also, in the wider European space, other markets have picked up the slack in the IPO pipeline, particularly Germany, most notably with Rocket Internet and United Internet.
OK, thanks, John. Gustav, coming to you. You've been looking into a major fertiliser deal that could be on the cards. Norwegian group Yara and US-based peer CF Industries said they're in early stage talks that could lead to a merger. Can you tell us a bit more about this?
It looks like it could be a massive deal. This deal, if it happens, would create one of the world's biggest fertilizer makers. And it started quite recently, some weeks ago, as far as we have learned. And it seems both companies were really interested in the deal because they both believe that it would add value to them. It would take a few more weeks of talks before Yara's and CF's boards can make the recommendations to shareholders. So it remains to be seen what happens, for example, with the HQ's location and the corporate government's lineup and so on.
But what's the rationale? How would it add value for investors?
It's supposed to give big synergies, obviously, first of all. But then if you look at the individual parties, for Yara, it's a matter of getting inroads into the United States and North America, where they're quite small at the moment. It's a big market for fertilizers. And just as importantly, it would give access to shale gas, which they have in abundance in the United States and Canada, and which is quite cheap. And that's one of the major inputs for nitrogen fertilizer production. For CF Industries, it's a different deal. It's focused on North America, but it is quite small in other places, and they would get access to Yara's distribution network. They have sales in about 150 countries.
And what do investors in both of the companies make of this deal?
In general, it seems people are happy about the deal. You can look at the share prices of both companies, which are up. But I think the most interesting part here is Norway's government, which owns 36% of Yara. They have stated in the past they want at least 34%, because with that stake, they could block statute changes and moves like moving out the HQ from Norway. But in a merger of equals, they would probably have to invest more in order to keep the stake and not get diluted. So we have learned that the government is looking into the issue right now and have not yet decided what to do. OK,
thanks, Gustav. So, Alex, coming to you, the big news this week is from the US Treasury, who's proposing to change the tax inversion rules. Can you explain briefly what's being proposed?
Yes, well, we were expecting something from Treasury Secretary Jack Lew. The political rhetoric since the Pfizer-AstraZeneca situation has really stepped up in the US regarding how US companies are re-domiciling out of the country in order to pay lower tax bills and access the offshore cash that they've got, pretty much tax-free. Now, what we've seen is a number of proposals that will date back to the 22nd of September. Most of them really focus on how these companies are able to shift the offshore cash around post-inversion in the new structure. There's also one that focuses on stopping the companies using sort of sneaky ways to change their shape pre-inversion in order for them to tick the size boxes, this 80-20 rule. So say paying out a special dividend beforehand in order to lower the market cap of your company in order to meet that 80-20 rule. Obviously, there's scores of lawyers still sitting locked away in rooms in Washington and New York and Chicago trying to figure out how these changes affect specific deals as well. So still a lot of work being done trying to interpret the new laws.
And we're following some of these deals. How is this going to affect things?
Well, we got early reaction on a couple of these. Covidien Medtronic was one and Shire AbbVie was the other. Generally, the early reaction has been okay. Now, I've been focusing on Shire, and sources close to that company pointed out to us, look, there was no special financial engineering going on pre-inversion, pre-announcement to get us within the 80-20 rule. So they're generally comfortable on that. Now, there's also, they point towards the strategic rationale of the deal. AbbVie executives went out of their way to say, look, this deal isn't primarily about tax. This is strategic rationale. We can diversify and we can broaden our reach. It's sort of a strategic deal with an inversion chaser, someone told us. So initial reaction is that it should keep going through, but obviously still scores of lawyers sitting around those tables trying to figure out how it really will impact them.
Okay, thanks Alex, thanks Gustav and John, and thank you for listening.